Okay, good morning, everyone. Welcome to day 23 of the workshop, Strategic Financial Reporting Sessions. Last time we met, we discussed much more on amortized cost, and we demonstrated how we harness the use of effective interest method to more or less explain amortized cost measurement and how that method is able to generate effective interest rates using various methodologies such as try and error, using Excel formulas such as GoSig, such as IRR, XIRR, rates, functions, and etc. And we also demonstrated what you can do mathematically by way of solving for the effective interest rate. And we went on elaborately to discuss those aspects. And as a follow-up to what we did before last class, where we have some deliberation on fair value measurements in line with Ifrs 13, what we more or less tried to do, which I gave as a task when we wrap up last week, was to more or less provide solutions or suggested solutions to this financial instrument problem with respect to fair value. Okay, and I believe we've done that, but we're going to demonstrate our understanding now. Okay, I want somebody to read question 5, and from there, we can be able to more or less attempt solving the problem in the way and manner in which IFRS requires us to do so. Over to whoever is interested to read the question.
Okay, question 5. On 1st May 2019, AVA Limited acquires shares in a corporation Multida, intending to hold it for a long-term investment horizon. The initial cost of the investment is 5 million, 1 million shares at 5 naira per share. And as at 31st December 2019, the market price of an identical quoted company shares is 5 naira 10 kobo per share. Given that AVA Limited has elected to recognize the changes in the fair value of the equity investment and other comprehensive income required, how should AVA Limited account for its equity investment upon initial recognition on 1st May 2019 and subsequent measurement at the reporting date 31st December 2019?
Okay, thank you very much for that. Thank you very much for that. Okay, how do we do that? Let us go back to our Excel workbook. Okay. Let's bring out our variables. Trade dates on purchase of shares. Our trade date was 1st of May 2019. Purchase price, which is our investment value, is 5 million. Let me try and put Naira sign. Currency, 5 million. What other information? Reporting date. of 31st December 2019. As at the purchase price was based on the fact that we have number of shares acquired and that we have market price per share purchased. They gave us 1 million shares. This is not in Naira. And they gave us 5 Naira per share. Okay. As at the reporting date, the market price per share as at 1st December 2019, which is the reporting date, is now 5 Naira 10. Okay, what information again? Nothing. Now, the key information here is that the company acquired with an intention to hold for a long-term investment horizon, which means it's not for trading. Okay. Furthermore, information shows us that given that Ava Limited has elected to recognize the changes in fair value of the equity investment in other comprehensive income, depict as such that first, the category of this investment is financial assets considered to be measured at fair value through other comprehensive income. Now, if that is the case, what then do we do? We are told, how should this be accounted for at the point of acquisition, and how should it be accounted for at the reporting date? Upon initial recognition, at what date? 1st May 2019. We recognize it as a financial asset. The equity investment should be recognized as a financial asset, as does. What do? You debit an account and you credit a corresponding account. What account do you debit? Financial assets, and what do you credit? Your mode of payment, which in this case, I can say you pay via bank. And how much do you pass as the entry? The entry is simply the product, in case you are not given the value directly. It's a product, which means it is the price, market price per shares at acquisition times the number of shares acquired. In this question, there's no transaction cost. There's no transaction cost. That is it. Now, this is the first issue. The second issue is at the reporting date. At the reporting date, when is the reporting date? December 2019. What do you do? At that date, the financial assets will be measured at its fair value with the difference with the fair value gain or loss reported through other comprehensive income. As shown below. As we showed below, okay. Now, what's our fair value gain? Our fair value gain equals the difference between 5 naira, 10 kobo, and 5 naira multiplied by the 1 million shares. And in that case, what is it? It is the difference between 5 naira, 10 kobo, and 5 naira multiplied by the 1 million shares. And that gives us 100,000. How do you do it? There's an increase in the value of financial assets. We increase the financial assets. And there's a gain, fair value gain, to be reported in other comprehensive. And that's the position of the standard. And that depicts what we need to do at that point in time. Any question on this? Any question at this point?
Zamiwa.
Yes, sir.
So you said the market price as at the reporting date is 5 naira 10 kobo. Based on the question actually said so because we are using an identical quoted company shares. Because what I from my own experience, my own work experience is that most of our, like my company, some of our shares in unquoted companies, we don't measure them. So when I was trying to find out from the CFO and other people, and they said that the auditors need to find a way to use the audited financial statement of that company to measure those assets properly, that we can properly record gain or losses. Because I know that those quoted companies will always use the market price as of that reporting date to get the fair value gain and all those things. But that is what I got. So I just took it like that. So with this information now, I think maybe I may have to update or tell my CFO that this is what we need to do because we cannot leave it to the auditors. I don't know what's your take on that, because that is the initial, my understanding initially based on that information, because so I'm just sharing my experience.
Thank you very much. Thank you very much. That's the reality of things. I always, how will I call it? I always feel worried when people rely on auditor on one or two things. You understand? But I will more or less expatiate on it in a few minutes, where I will give you guidance on it and what to do. Is that okay? Just give me a few minutes.
Okay.
Yeah. One of my systems is acting up and I need to address it. Okay, sorry, I'm back. Now, when people say auditor, and I love that, are you aware that you have the responsibility other than the auditor? Auditor is to come and independently evaluate whether you guys are in compliance with whatever exists in line with the standard or in line with regulation. Therefore, on that basis, you need to, when I say you, those responsible or saddled responsibility of on financial reporting need to know what to do and resources they need to annex. Now, with respect to this, when you invest in unquoted equity, okay, there are various ways or means to which you can obtain fair value. That's the first thing you need to know, okay? Even if auditor advises you and advise you well, it's on the premise that the knowledge the auditor has acquired, which also you need to have acquired, because no one needs to know more than who owns the account, which is you guys.
That's true.
Now, what happens most times is that I make many heads of finance effort to understand that it is your call. It's your call. It's only when you need support, you can probably engage consultants or, you understand, have some level of discussion with auditors. But most times you find out that many finance professionals are laid back by just dumping everything to consultants or dumping it to auditors, whereby they are not even interested in developing themselves towards knowing what is needful. You know that more than 80% of accountants cannot challenge the auditor in engaging in discussions when it comes to critical issues. You understand? Once auditor even tell you jump, they'll say, okay, auditor has spoken, jump. Whereas auditor is not even, they are like you that are also subjected to those changes in standards, and they also develop themselves and they also tend to acquire knowledge. Okay, now what we need to do is that we need to go back to our discussion. Okay, in our discussion, we extensively discussed that, okay, we have 3 levels to which financial instrument can be, the fair value of a financial instrument can be obtained. We talked about level 1, level 2, level 3. Level 1 are quoted prices that are unadjusted. Level 2 are observable market inputs or quoted prices that are adjusted. And level 3 is when you make use of unobservable input majorly. But we also said, apart from market price that are quoted prices, level 2 and level 3 can be obtained majorly from various methodologies that are applicable. Okay, and I think I demonstrated that in our discussion. Let me put up this slide so that you can also refresh your memory and go back to our discussion at that point in time. Okay. I'm trying to call it up. Okay, I believe you're able to see my screen now. Okay, I'll quickly take you to the hierarchy levels here. This is the hierarchy level I just explained.
Okay, yes, I can see it.
Okay, and I made clarification on this. Input to valuation techniques. Now, what your auditor, you are trying to say, your auditor do on your behalf or in your favor is this. And what happens is that we have three approaches: the market approach, the income approach, and the adjusted net value approach, which is more or less like the cost approach. And I'll explain again. When you talk about market approach, you are trying to look at, okay, the company you are talking about has peers in the market. Okay, let us say the peers in the market, let us say company A has a comparable company in the market, which is company B and C. The question then is, what is the market value of company B and C? What is the earnings of company B and C? We use that based on some level of adjustment to obtain the PE of those two companies, B and C. And if the PE of B and C is 5 times, for example, that means that there's no way, since you have said they are comparable, there's no way the PE of company A that is unquoted will be more than 5 times or up to 5 times. Therefore, the question is, you will adjust the PE for market discounts. And what is market discount in this case is because a company that is comparable to a quoted company, which in its own vein is not quoted, cannot have PE up to what the market PE is, because market PE also reflects market information that an unquoted company does not enjoy. Which that means if PE of a quoted company comparable to company A is 5, okay, I can say, okay, there's a 20% market discount based on the fact that it's not quoted, which then means that 80% of the PE of a quoted that is comparable, which is 4 times, will be used as a basis to value company A by saying 4 times the earnings of company A should give it the market value. And from there, I can divide the market value by the number of shares. And at that point in time, I get what the market price is per share. That's one way of doing it, which is a market approach. Another way of doing it is income approach. By saying, okay, let's look at the projected cash flow of this company. Let's look at the trajectory of this company and try to obtain the cost of capital of the company. And let's discount the cost of capital to obtain the value of the company as a whole before we deduct the debt. And by the time we deduct the value of the debt from the entire value of the company, we derive our enterprise value, which is more or less like the equity value of the company. And we divide by the number of shares to obtain what should be the approximate price per share. Another approach, which is what you said the auditor is using, is the adjusted net asset approach. What happened is this. What the auditor would do in that regard, let me use Excel. What the auditor would do in that regard is this. Let us assume your net assets as at the reporting date is as follows. You have, let me say, PPE, you have investments, you have intangible, you have a right of use assets, you have inventory, you have receivables, you have cash and cash equivalents, you have payables, you have current tax payable, you have, okay, let's say this is what you have. Now, this is your carrying amount. This is your kind amount in Naira. Let's say 1 million, 2.5 million, 200, 2.2, 500, 4 million, 800, payable, lease obligation, okay, which means your net assets is this. This is your book value. What the auditor is now trying to do is say, okay, let us obtain independent fair value of these items. Let's say we fair value our PPE and there's land component in it and it has appreciated. Therefore, probably it has appreciated to 2.3820, like that. Investments, I'll say just marginal. Intangible remain the same. For example, right of use assets, value is 1.6. Inventory. Receivable, I'll say it didn't move. Cash and cash equivalent down cannot move. Payable, I'll say it didn't move in its respect. Current tax cannot move. Lease obligation, I'll say it didn't move. These are negatives. Okay. What do we have? Now the question then is, what is the number of shares? Now, this is our fair value. This is the kind amount, this is the fair value. And this is the value the auditor is using. And they can just compare and say, okay, you have investment there. Now, how many shares are in that company? 1 million shares. They will now estimate estimated fair value based on adjusted net worth asset value, which is also this will be level 3, and the auditor will disclose it, or you will disclose it in that manner as level 3. And what would that be? It will be this divided by this. And that's what the auditor will give to you. Does that look like what you do? And now,
so the figure, yes, I said the figures are usually, would I say reported? I don't know how they arrive at those figures. So I think with this, I will need to find out exactly how they arrive at their figures. I need to ask more questions.
Yeah, you have to ask one question because all of these figures, remember we have discussed fair value. Go back to the
Yes.
PP. It is issues like PP, inventory, which are physical assets, right of use, intangible. All of these, you are going to use the methodology which you call I and best use. If you remember, when we talk about IS and best use, that's what you use. And for investments, therefore, you have to obtain where do you have the principal market or most advantageous market, similar to receivables, payable, and probably lease obligation. Things like taxes and cash, that one will never change. No changes, because by their nature, they already reflect what the value is at every point in time. Okay, except in the real situation with current taxes, where there might be implication because of time value of money in certain jurisdictions. Okay, but that is that. Now, the issue then is, what if you have no reasonable basis to do some of those things? Therefore, there's an avenue to which the standard allow you to use dim cost, but it's very rare, which means you see what I put here, cost approach. Cost approach means you carry it at the same amount you bought the investment for, but one thing you must compulsorily do is that you must subject it to impairment assessment. You subject it to what? Impairment assessment, which means you are going to impair it if it demonstrates a loss of permanent nature. Okay, you can go back to that and you can read more of what I've said here. Remember, these are also what I've discussed just now. Okay. Now let's move further. Now let's look at, I'll put this as, let me just put it here. Let me label it adjusted net assets. Well, okay, now let's look at question 6. I want somebody to read question 6. Over to you.
Question 6. On 1st May 2019, AVA Limited acquires 1 million shares in a corporation, Maltida PLC, for 50 naira per share. The company, upon purchase of the shares, incurred transaction costs of 1 million naira. The reporting date of the company is every 31st December. As at the reporting date, 31st December 2019, the share price of Maltida PLC was 54 naira, and before the reporting date given 20 June 2019, AVA Limited had received a dividend of 2 naira 10 kobo per share from Maltida PLC. Required, show the extract to the financial statement of AVA Limited as at 31st December 2019 concerning investments in Maltida PLC, assuming A, the motive for holding the investment is speculative or for the sole purpose of trading. B, the shares were purchased as a source of income generation, such as dividend income stream, long-term capital appreciation, and were the subject of an irrevocable election at initial recognition to recognize them at fair value through other comprehensive income.
Okay, these are the information. The purchase date is 1st of May 2019. The purchase details are number of shares acquired, 1 million shares. The market price per share purchase was 50 naira. The reporting date was 31st December 2019. The market price per share on that date is 54 naira. Okay. It's 54 naira. Okay, dividend was received on 20th of June. And how much was that? 2 naira, 10 kobo. Okay, okay, that is that. Now, there are information here given to us, okay? And the first information is that, given the information we have, how do we show an extract in our financial statement such that we assume first that the motive for holding investments of this nature is for speculation or for sole purpose of trading, which means in the process of trying to find solution, we have two categories here. We have category A and we have category B. Okay, category A, let's deal with A first. When your business model revealed to us that your sole aim of holding this investment is to speculate on it or make appreciation to trade on it, therefore, what category can this fall into? Who can answer that? Which category does it fall into?
I think that should be fair value profit and loss for trading purposes.
Yeah.
Fair value profit and loss. Loss.
Okay, thank you. If that is the case, let us start. We recognize a financial asset, is that not?
Yes.
Okay. And we recognize as fair value. And what's fair value? It is the 1 million shares acquired times the 50 naira. And that's how we got the 50 million naira. Now, was there transaction cost? Yes, I think we omitted it. There was transaction cost. In this case, they gave us transaction cost as an absolute amount. And it was 1 million naira. Therefore, how do we treat transaction costs for a financial asset measured at fair value to profit or loss? How do you treat transaction costs? How do you treat transaction costs? I await your responses. How do you treat transaction costs on financial assets measured at fair value to profit or loss? This cost should be what? Expense or charge to profit or loss. Therefore, if that is the case, what entry will I pass? Rather than debit financial asset, I debit my profit or loss. I credit mode of payment. How much is it in this case? It's not even a product. They've given us the amount in absolute terms, 1 million naira. Now, subsequent measurements. Now, subsequently, the first item we have here is that we add dividend income. And how do we report dividend income? On the 20th of June, 2019. How do you do that? This will be credited to profit or loss as an investment income. as thus. Now, what do we do? For receiving cash, I credit mode of it. Mode of receipt, which is bank. And if it's not yet received, but is duly declared, you can account for it as an asset, dividend receivable, provided it meets the requirement of IS10. And IS10 talks about events after the reporting date, and also IS8 also may apply. Okay, and your credit is your profit or loss. How much is it? Is the amount of the dividend, which means the product. Dividend per share is 2 naira per kobo times how many shares do you have? You have 1 million shares. That means you earn 2.1 million naira. The second item there is as at the reporting date. Reporting date, which is 31st December 2019. How do you measure? Therefore, this investment will be measured at fair value with the fair value gain or loss reported in profits or loss. Okay, reported in profit or what? Or loss as thus. Now, how do you report it? You increase your financial assets and your gain, instead of going to OCI, it will go to profits or loss. Okay, how much is the gain? The gain is now the difference between the 54 naira and the 50 naira multiplied by the number of shares, which is 4 million naira. Therefore, in this case, I'll put it 54 minus 50 will give us this. Okay, any issue about this for scenario one?
Hello.
Yes.
Yes, I just like to confirm something. For the measurement of the gain, fair value through gain, profit or loss, are we charging it into profit or loss because the investment and the asset is meant for trading, the nature of the asset, unlike through OCI? I'm just trying to confirm.
Are you in our session where we discussed classification?
Though I missed last class anyway.
No, it's not last class.
I was in the second. Yeah, it's not last class. Yeah, classification. Yeah.
You were in the class.
Yeah, I was in class.
Yeah, I wanted to show you something so that I will go back, because everything we discussed plays significant role. Okay. Okay, this is it. Let me enlarge it. Now, look at these attributes we define. We'll try to define it for the three of them. I'm sorry, it's 115. Can you read it out? Can you read it out?
Okay, fair value through profit or loss. Fair value through profit or loss. The attributes are: one, it must be held for trading. Okay. Capture market appreciations. Okay. Second one, upon initial recognition, they are
Designated.
Oh, they are designated at fair value through profit or loss. This is done usually to eliminate and avoid accounting mismatches. Yeah, okay. And the third attribute is
that all derivative assets fall under that category.
yes, all derivative assets fall under that category. Okay.
Read fair value through OCI. So
in the case of fair value through OCI, cannot be the attributes are: one, if it cannot be grouped either to at fair value through profit or amortized cost. Second attribute is equity instrument that an entity has adopted by way of an irrevocable
right of election.
Irrevocable right of election. The mismatch to be, is it incurred?
Okay, let me read it.
At fair value
equity investment that an entity has adopted by way of irrevocable or irreversible right of election to be measured at fair value to OCI. Does that make sense now? Does that answer your question?
It does, yes, it does. I recollect this.
Yeah. And if you read A says, assuming the motive for holding the investment is speculative or for the sole purpose of what? Trading. That's why we categorize. But yeah, read B. What does B say in this case?
Now, B, the shares were purchased at a source of income generation, as a source of income generation, such as dividend income stream, that is long-term capital appreciation, and where the subject. Please, can you please help me with the font, please? Okay, let me read again now. B now.
Yes. Continue.
Okay, now B. The shares were purchased as a source of income generation, such as dividend income stream, long-term capital appreciation, and where the subject of an irrevocable election at initial recognition to recognize them at fair value through other comprehensive income.
Okay. Now, what that summarizes to you is that he has even given you the answer. That by irrevocable election, he has decided to measure this at fair value through OCI, which is similar to the first problem we saw. Now, upon initial recognition, is still going to be measured at fair value, similar to what we've done for the first category. And transaction cost here, rather than being expensed, the transaction cost will be added to what? Will be added to the initial value. And what it means is that instead of charging to profit or loss, you add it to the financial assets, assuming you purchase that asset for 51 million. That's what it means. It means the product. That's the 1 million. When you add 1 million to 50 million, it becomes 51 million. Now, the next one is the dividend. Regardless of how it is, the dividend will be more or less derived in the same manner and accounted for as income, regardless of the classification of the equity investment. And therefore, 2 naira 10 kobo multiplied by the number of shares you own. Why fair value gain or loss will be measured as thus? Now, how do we measure this? You measure this at this, which is fair value gain, but don't forget there's a transaction cost that is yet to be expensed. And therefore, you deduct that transaction cost that is outstanding, which is 1 million naira. And when you deduct that, what it simply means is that you have 54 naira minus 50 naira times 1 million shares. That should give you 4 million. But you have transaction costs that you have kept somewhere, which you now have to deduct against that amount. What's my transaction cost now? Minus the transaction cost. Going forward, you have exhausted the transaction cost and no longer coming. And this is the position of it. And this 3 million. You can see the area of differences. Why up to this point is, and this also area of differences, but at this point, there are areas of agreement. Does that make sense now? Does that make sense?
Yes, it does.
Okay. That answers the question. Any other question? Any other question? Any other question? Okay, let me find. I gave another question. Okay.
Sorry, sir.
Yes.
I just go through the category B, or there is something I need clarification on. When we look at transaction costs, I mean the second solution, which resulted into 1 million naira. Transaction cost on 1st of May 2019. The cost should be added to the initial fair value, which we debited to financial assets. I'm looking at the corresponding entries, which we credited mode of payment. I think we should credit other comprehensive income.
What? You paid 1 million naira to buy as brokerage fee.
Okay.
You pay cash. How come your cash you will go to other comprehensive income? I didn't get it.
I am a bit confused.
No, okay, let me put it to you. You are put yourself in the shoe. You are the one that bought 1 million shares at 50 naira. You told the broker, buy me shares of GTB, 50 naira each. Buy me 1 million units. And broker says your brokerage fee for everything is 1 million naira.
Okay.
Is that means what to pay broker is 51 million.
Yes.
Uh-huh.
Oh,
Therefore,
I
how
understand.
does that affect other comprehensive income?
Yes, it's clear. It's clear
You
now.
paid 1 million naira for them to execute that trade for you.
Exactly.
That's it.
Thank you.
Okay. Now, there's another tax I gave you guys. Let me check. I gave you this tax, and I want, if you've done it, I want a random answer from you, because it's a very simple question, provided you have understanding of it. This is a question. Okay, who will answer it? Has anybody attempted it before? If not, we'll look at it together. Okay. Can somebody read the question?
Question 7. Asna PLC issued 1 million naira bond at par with a coupon of 8% per annum. The directly attributable issue costs were 20,000 naira. The bond is repayable at the end of the 4 years and a premium of 10% of the par value required. What is the total amount of the finance cost associated with the borrowing?
Now, the finance cost over a period of 4 years is as follows. I'll figure in naira. Now, the first cost you incur is transaction cost, the issue cost. When you're about issuing bond, you issue it through brokers or through the relevant institution, and you incur cost of 20,000 naira. Thereafter, you have to pay coupon. The coupons you have to pay, which represent your interest, you have to pay over 4 years, is as follows. You pay what percentage? 8%. Okay, let me just put the parameter. Let me take my solution somewhere here. Let me put my parameters here. What are the information I have? I have bond face value. I have issue costs. I have coupon rates. I have duration or tenor. Yes. I have premium on redemption. I think that's all. Okay. Face value is 1 million. Issue cost 20,000. Coupon rate 8%. Duration 4 years. Redemption 10%. 10% on par. Okay. Therefore, I said my issue cost is this. Now my coupon rate. My coupon is to pay interest of how much? 8%. 8% on what? On the face value, which means 8% on face value is 80,000. And I'll pay it for how many years? 4 years, which means I'm paying it 4 times as a frequency. How much will I have paid in all? 320 over 4 years. And upon redemption, I pay premium on redemption of the bond. Redemption means settlement. And what is the premium? The premium is 10% on the face value. That's 100,000. Hence, my total cost is this. And that's just the answer. Very simple. Now, what I can now do to demonstrate again is, remember that if you are to categorize this bond, category of the financial assets, we can simplify and say it is at amortized cost. Now, if it's at amortized cost, therefore, what would have been my entry? Let me copy what I have here. Upon initial recognition, there's no date given to us, and transaction costs. Okay, I'll debit my financial assets and credit mode of payment. What is it? 1 million. No, I'm the one that issued the bond, therefore it's not financial assets. Rather, this is financial liability I borrowed. Therefore, reverse will be the case. Your mode of receipt of money, no mode of payment, and you credit your liability, being the bond. Okay, similarly, transaction cost will be deducted if you go back to what we have discussed earlier. From, and in that case, and what is transaction cost? 20,000. Now, invariably, if we copy our amortized cost schedule, okay. Now, what's our initial Our initial amount will be 1 million minus 200,000. Liability, not assets. And if it's liability, you deduct, because what it really did is to reduce your balance. That's 180. Therefore, what's our effective interest rate? We are going to determine our effective interest rate. But what is our cash flows? Our cash flows are as follows. Each year, pay interest of 8% on the principal, which means you pay 80,000. I can lock it. You pay 80,000 for 4 years. When I drag it down, you pay 80,000 for 4 years. Now, in the last year, this is the 320, can you see it? But in the last year, you pay the premium. What is our premium? Our premium is the 10% of that 1 million, which means I pay 100,000 in addition. That means I pay 180. That's what it means in the last year. Now, let us now ask ourselves, what is the effective interest rate? We can use rates in Excel. We can use IRR in Excel. I think I'll just use those two. Now, what is rate? Rate in Excel again. Number of period is 4 years. Okay. The net payment is 180. If you remember, it's 980. 980 is 1 million minus 20,000. Sorry, what? Okay. Let me do it directly so that I can have better appreciation of it. Rates. Have I used it before? If not, let me just type rate and call it up. Now, the number of payments is 4. Payment you pay annually is the products. That 80,000, how do you get it? Is 8% times 1 million. That's the 80,000, you can see it. Present value is 980. 1 million minus 20. Okay. Let me just pick it from here. 1 million minus 20. Okay, it's because I'm putting the Naira sign in it. Okay, let me remove the Naira sign. Number of payment 4. Product. Product 8 and this 80. PV.
When you are going to shop on Monday, you take my clothes for ironing.
This future value. How much you are paying back in future? You are paying back your 1 million. You are paying back your 1 million. And you're also paying back premium. And premium is 10% of the 1 million, which is you are paying back 1.1 million. But let me just put 10% multiplied by 1 million. Why is it showing me invalid? 11B. Okay, I get it right. It's showing me invalid because, okay, I put is equals to there. No problem. Okay, and type, remember, is type 0. Now, all this information should give me effective interest rates, but it's giving me error. Where's the error coming from? For this, yeah, okay. Let me put the PV in negative. Yeah, this is effective interest rates. If you do it to a long decimal, okay? I think it has gotten to the peak at that point. Okay, I can also do it using the table of estimated cash flow. Let me just do a simple table of estimated cash flows. Yeah, 0, 1, 2, 3, and 4. What are my cash flows? Cash flow types and my cash flows. Cash flow types and cash flows. Cash flow type, borrowing, net borrowing, you pay coupon up to year 4, and in year 4, you pay back the par value and you pay back the premium. Okay, let me do it in this form. Let me do it in this form. I'll just do it here. Borrowing. Transaction cost or issue cost. Coupon. Redemption value. And net cash flows. You borrow in year 1, money came in. The net borrowing is 980, which is 1 million minus 20,000. Issue cost, the money, okay? The issue cost is 20. Let me separate it. from the borrowing. You borrow 1 million, we'll net it later. Coupon, you pay interest. At what rate? 10% on this. That is that. And this amount is fixed for 4 years. You pay for 4 years. Upon redemption, you pay the 10% as premium on the 1 million, and before you now add the 1 million to it, which means at that point in time, you pay 1.1 million. Now, what is the net cash flow? The net cash flow is for us to sum up everything across board for each of the years. That's 980, which we come back to. Therefore, this is our cash flow. 980 net came in, and over the years, the whole of this sum went out. Now this 8%, 80,000. Okay, if you net it off, what do you have? You have the total finance cost, which is that 440 again, which means another way of getting this 440 is this. Now, what is our XIRR? Our XIRR, which is what we want to get here, is to say IRR into, we can open it. What is our pattern of cash flow from year 0 to year end? I can guess and I can guess not. And it will still give me the same amount. And that is it. Now, I can now use that as my effective interest rates. Now, what is my effective interest rate? I apply that. My effective interest rate is either of these rates, and I lock it. And once I use it to unwind, you can see what I get at the end of the day. The 1 million, which is the initial 1 million. And since you are going to settle that 1 million off, I can add the 1 million back to it, be the face value. And as at the time I paid that 1 million off, apart from premium, interest, and transaction costs are paid over 4 years, what is left is 0. That's it. What is left is 0. Now, what was the net borrowing? The amount we borrowed was 1 million. Now, what is the contractual interest? 420. The difference between the contractual interest and finance cost, which is effective, is that transaction cost of 20,000, which has been amortized. Likewise, we have amortized the premium of 100 also. And this is still trying to reflect. But where the question requires us to do stops at this level. But I only use the opportunity again to demonstrate the understanding of transaction costs. Any question at this point? Any question at this point? Any question at this point? Okay, we'll go on slide break, which is 5 to 10 minutes. We'll come back 12:05. As at that point, I'm going to display something on the screen, which will be the beginning of our discussion on impairments of financial assets. Impairment of financial assets. Welcome back to our section. We'll continue from where we stopped. Now we'll more or less delve into impairments. Now, when we talk about impairment, the general notion of impairment is that a financial asset is said to have been impaired when its recoverable amount falls short of its carrying amount. What does that mean? It means that you have a financial asset to which what you carry it for is 10 million. But evidence has shown that you can no longer recover all of the 10 million. And what you can recover is 9.6 million, which is a recoverable amount. The difference between what you can recover, which falls short what you carry it for, is said to be the credit loss, or what we call the impairment loss. Now, the question then is, impairment of a financial asset is to be more or less carried out more frequently, and especially not later than once every year, which means in every 12 months, at least every financial asset should be subjected to impairment assessment. Now, the question then is, impairment assessment under Ifrs9 has changed drastically away from what we know under IAS 39. The methodology adopted under IAS 39 is much of incurred losses, while in IFRS 9 is much more of expected losses. The question then is, what are the differences between the two? IAS 39 model is incurred loss model, while IFRS 9 model is expected loss model. The distinguishing factor between them is this. IAS 39 incurred loss model recognizes impairment loss later than not, whereas IFRS 9 expected credit losses recognize impairment earlier than not. What does that mean? All of us were familiar with what happened in 2007, which spanned to about 2009 with respect to global economic crisis, which took its toll in 2008, much more. And investigation that came out of that shows that this may have been prevented to some degree if losses have been recognized or expected or estimated earlier than not, than when they actually were recognized. And that brings about revolution towards redrafting the standards with respect to IAS 39. And that is what brought about the expected credit loss model. Expected credit loss model anticipates, based on prudence concepts or the principle of conservatism, losses to every financial asset at the inception of such an asset. And what it simply means is that unlike IAS 39, where loss events may have crystallized before such an impairment is recognized, IFRS 9 expected credit loss model anticipates that every financial asset has a degree to which it will record losses, only that the frequency and the severity is what might vary based on historical data, macroeconomic variables, and some other things unique to such financial assets. And that is what IFRS 9 is trying to look into. So that from day one, when you become a party to a contractual instrument that creates a financial asset, you start to record losses that are expected from such assets on a collective basis in most cases, and also in extreme situation, maybe on an individual basis. And that is what brings about the reshaping of the narrative towards the impairment modeling. Okay. And that is that at that point in time. Okay, I want us to make one or two input contributions before I further ahead in our discussion. I've only just dropped an excerpt, trying to bridge the gap between where we were coming from and where we are now and where we are likely going to be in the future. Over to you guys.
Okay, good afternoon.
Afternoon.
So yeah, I just appreciate this point, because I remember some years ago, a few years ago, when I went for an interview, I was asked my understanding about the ECM model for financial assets, and I was at a loss. I didn't even know what to say then, because I hadn't come across it, frankly. So when as I saw it now, I'm looking at it, okay, oh, this is what they were even referring to. So sometimes all of these things they are quite important. But be that it is, you mentioned that before you can do this, a model. So basically, it's not something you just carry out. You must look at the economic factors, interest rates, maybe foreign exchange gain. These are the, so you must take time to build a model. I think that based on when you say the model now, so for a company to do this, it's going to be quite expensive. I don't think it's a company that will just do it. May have to employ the services of somebody who will look at all these parameters before you can draw up a proper model for an organization that invests a lot in financial assets. I think that is my understanding of what you just said of this.
Okay, yes, you got it right. Investment is key, but again, you start from somewhere. Rome is not necessarily built in a day, okay? And we're going to discuss on that as we move on also. Thank you for that contribution. Who else?
Good afternoon once again, everybody.
Good afternoon.
Yeah, similar to experience that Enauro had, I had similar experience, honestly, because I was in a phase of interview and they asked me several questions with respect to financial statements, which I was able to answer correctly. But when it got to Ifrs9, I personally, I knew that I was just beat around the bush. I was not specific with, because I just have I heard about Ifrs9, but I don't really understand it. In view of that, I knew that I was totally lost with what I was saying in respect of Ifrs9. In another occasion, in fact, this is the first time I have a view on impairments of financial instruments. As a matter of fact, I really appreciate this lecture, and I gain a lot on the lecture. And hopefully, for the expected loss model and incurred loss model, I definitely believe that Mr. Muiwa will put us through and give us a roadmap on how to go about everything that has to do with impairments of financial instruments. Thank you.
Okay, thank you. Who else? Who else? Babajide?
For me, I have high expectations in actually learning the models. And from what I've not been consistent with the classes, but from what I've actually, from the questions solved today, I think I've been able to grab a lot from financial instruments, measurements, and recognition, measurements, initial recognition, and subsequent recognition. So I'm fully hoping that I will get more better understanding from the models that we are to discuss. Thank you, sir, thus far.
Okay, it's not enough excuse that you miss some classes. The beauty of it is that all of the classes are recorded.
Yes,
and
yes.
You have a higher responsibility to ensuring that you make up for the lost periods. Is that okay?
Yes, sir.
Okay, Madam Anne, over to you, ma'am.
Good afternoon.
Good afternoon, ma'am.
What I would say is that from what you have said, I don't have a contribution, so to say, other than that I'm learning, that this program is actually an eye-opener to so many things, if nothing more, or that is actually compelling one to be aware of what is surrounding ones in the area of one's profession, and the need for one to research more and understand what one is doing, which now will make me to ask this question. In your explanation, you said something about at least once in a year, an impairment test should be carried out. So my question is, what happens if such test was not done?
What happened if what, man? I didn't get you.
Where the test was not done, there was actually an impairment. What happened if an impairment test was not carried out?
Okay, thank you very much.
Did you hear me?
Yes, I do hear you. Okay, what you need to take note is this. It is a must that it is done. It is a must, which means not doing it is a deviation. Not doing it is a deviation from the requirement of IFRS.
Okay.
I remember auditor is responsible to verify and certify that your what's it called, financial statement is a reflection of or is in compliance with IFRS. Otherwise, such a financial statement may be qualified by the auditors. Okay, now the question then is, it is not the degree to which it is done that might vary from entity to entity. And one thing again is that you don't get to the peak in a day. You continue to improve on the model as time goes on. Because remember, it is an estimate. And an estimate is bound to subject to changes based on new set of information. And that's what you need to take note of. Does that make sense now? Okay, that is that. Thank you for that. And what we're going to do now is that before I start impairment, we'll watch one or two videos. Okay.
Ifrs9 Impairment introduced a fundamental changes in impairments. In the past, with IAS39, we were looking backwards at an incurred loss model. With IFRS 9, we are looking forward with an expected loss impairment model. While incurred loss is the past, is certain, is easy to measure, the future is more difficult to determine, to evaluate. So we need to use risk management techniques. From a practical perspective, what is the impact? In IAS 39, you were only booking an impairment allowance if you have a default event. So only late. Now, with IFRS 9, from day one, you will book an expected loss impairment allowance because from day one, you have some expectation of loss. So the impact on the P&L is really, really important and material. It has to do with P&L and capital requirements. IFRS expected credit loss model impacts really the P&L, the profit and loss. And you know this is key to the board. While on the Basel side, the expected credit loss model determines in the end the minimum capital requirement. The minimum capital requirements are very important, but they are just a minimal vital condition. This is the first element that is key. The second aspect is the lifetime expected loss. Who knows what will be the expected loss over the lifetime of a mortgage loan for 20 years? Only God knows. And the board doesn't know neither. And actually nobody really knows. And so this is a concern because it is really unknown. A third item that concerns boards is the really operational implementation of IFRS 9. It will be a challenge for any bank. Bank will not be able to be IFRS compliant using the current credit risk models. The reason is that there will be too much differences between the risk models. Under IFRS, the time horizon required to compute the lifetime expected credit loss, while usually in the credit model you will use a 1 year. The time horizon is a first difference. A second point is that IFRS takes the point of view of now, of the reporting time. So it's a point in time view, while under Basel or under usual credit risk, you take a through the cycle. So this is another difference. A third difference is that IFRS will prescribe you to use the effective interest rate to discount the cash flows. Next to that, the models under IFRS will also have to use more macroeconomic factors, and will also have to use different scenarios, what you are maybe not doing under your current credit risk models. The challenge will be how to leverage what you already have in your credit risk model to build IFRS models and make them consistent. And this is the challenge. The first challenge is to translate the IFRS guidelines into policies and procedure. You will have to have your own definition of what default is, what low credit risk means for your bank and for each of your products. When it's translated, the second challenge is to implement them really in the practice. So for this, you will need the support of systems that will help you to enforce your policies, and that also will need to be flexible, because while the guidelines are really fixed, your policies and procedure may change over time. The third challenge is integrating and reconciling risk and finance. Risk from day one computes the expected credit loss, and from day one in finance they book it as an impairment allowance. So from day one you will need to reconcile every time and make sure they are consistent. And this can only happen if you have an integrated risk and finance solution. All these challenges are superseded by one challenge, being the governance. The governance is the first principle that Basel Committee issued on expected loss. It says that the board is responsible for the level of impairment allowance, for the level of expected credit loss, and it's responsible for the controls and the consistency with the accounting gap and the supervision guidance. So this is a real challenge to make sure that all that happens under the supervision and the governance of the board. Because of the major importance impairment can have on your P&L, and because of the involvement of the board, it is really necessary to do as soon as possible an impact assessment, so that the board has all necessary information in order to give the impairment project the right priority and the right resources. Once you've done that, there are two main streams. The first stream is about risk models. This is a very important stream, and it will determine the level, the amounts of impairment allowance, so the level of variations in the P&L. The second aspect is all the operational, all the architectural, all the systems impact. The relationship between them, the enforcement, the rules, it needs to be consistent and implement your policies. Those are the main streams. And you need to make sure that those two streams are really put under the strict governance of the board and that the appropriate information gets to the board. This is, we believe, a successful approach to implement the Ifrs9 impairment.
Good morning, everybody. Today, we're talking about practical issues when implementing IFRS 9. And you will remember that in January, we talked about practical issues when implementing
One of the main challenges that firms are facing when implementing Ifrs 9 is data availability. Although Ifrs 9 requires a forward-looking approach, both forward-looking and historical information is required, which means that banks that don't have that historical data set available should look for alternatives. On the other hand, this forward-looking information, banks first need to select which macroeconomic factors are relevant, and then they need to get these forward-looking estimates for these macroeconomic factors. For some regions or for some countries, these might be made available by central banks or by other institutions. For other regions, it will be more difficult to obtain that kind of information.
The firms in Canada are facing a rapidly approaching deadline to implement IFRS 9, face a lot of challenges. OSFI, the primary regulator in Canada over this, has spelled it out really plainly that they intend on rigorous implementations have to be performed, not part and piecemeal. So that basically is saying that you have to have the entire Basel guidelines in place from a technical, from a managerial methodologies, everything involved in it. So they've got a really short time frame if they're not well down the road with a path and a plan that they know they can achieve.
Due to being rather late in their IFRS 9 journey compared to their counterparts from advanced jurisdictions, banks in this region have limited time. And whilst they know what they have to do to meet the disclosure norms, they will likely need to enhance their regulatory reporting in light of IFRS 9 once corresponding regulations from this region are published.
Another challenge that banks are facing while implementing Ifrs 9 is the credit risk modeling. Ifrs 9 doesn't prescribe a method on how to perform the credit risk modeling, but it does require a certain level of sophistication. It means that banks will have to define themselves what methodologies they will use, how advanced these methodologies will be. It will be a trade-off between transparency and complexity, delivering results that can be explained and it can be defended, but at the same time also respecting that level of complexity. So banks that have these processes and that have these systems in place to measure expected credit losses and to do the credit modeling, these processes should ideally be streamlined and automated in order to produce reliable results.
Banks have to pull together data from finance and risk onto a common platform to meet the IFRS 9 implementation requirements. Banks have to collect macroeconomic data and build forward-looking models and conduct macroeconomic forecasts under multiple scenarios. They have to collect data to calculate PD at origination. Banks have to ensure that they secure adequate budget to successfully complete IFRS 9 implementation, and in process ensure that they secure buy-in from all the right stakeholders, such as from IT, business, finance, and risk. Banks with limited time should consider taking a transitional process where they take a simplified approach towards IFRS 9 modeling and implementation, and then in the second wave of their exercise be prepared to take an advanced approach towards IFRS 9 implementation.
The deadline of Ifrs 9 is approaching very fast. For banks who are quite late and who are still in the planning phase, they can opt for a phased approach, which means that they can start with more basic, more simple methodologies like practical expedience, for example, the provision matrix. This also means that management judgment will play a more important role in that phase. But once banks are compliant in 2018, they can make some corrections, they can make some improvements to their current data set, for example, build up or start building up that historical data set that they didn't have before, and start moving to more complex methodologies for the different portfolios which require that.
Banks that are still planning have to put it on a fast track to be able to comply within the deadline and the timeline that's allowed. So they can, but it's going to be really difficult. So what they need to find are the partners who can come in to put it on a fast track. They've got to address the classification, the measurement, the impairment, and the hedge accounting, and that has to be done in a complete manner, in an open manner, and a manner that can be shown that they are truly complying with all of the Basel guidelines. OSFI is going to be really looking at that, so if you're in the position of facing a rapidly approaching timeline and you're still planning, you need to partner with the appropriate people, whether that's from the accounting side and the financial reporting, or the technology and the data management and governance side.
Wolters Kluwer can help banks with their IFRS 9 implementation through the streamlining and the automation of their processes. Wolters Kluwer offer an IFRS 9 solution that combines finance and risk management into one single end-to-end IFRS 9 solution, covering segmentation, expected credit loss modeling, expected credit loss calculation, stage assessment, expected credit loss accounting, and disclosures. Wolters Kluwer can also help banks with the ever-growing regulatory reporting requirements. In the case of Ifrs 9, we specifically mean the revised FinRep templates. Delivering results that are transparent and the reports that are reliable are key for Ifrs 9 solution.
Welcome. I am Peter Plochen and I work as Risk Management Specialist within SAS. In the next few minutes, I would like to show you how SAS can help your financial institution to deal with the challenges introduced by Ifrs 9 impairments in the most optimal way. For those interested in the US GAAP version of the Ifrs 9 impairments, most of what I will discuss and show today is applicable also to the current expected credit loss model of the FASB. Let's get started. So what is this Ifrs 9 impairment actually? Some finance people say this is the biggest change in the banking accounting ever. Some risk people, on the other side, say this is the biggest project for them since Basel II. Let's explore now a little bit what could be driving such strong statements. Ifrs 9 impairments basically redefines the way how accounting of credit risk should be done. Compared to the current impairment regime, Ifrs 9 will have more financial impact, will require more impairments, and these will have to be recalculated more often in order to capture the changes in the underlying credit quality. The impairments calculations will be more complex and will require collection of more data and development of more models. Ifrs 9 principles offer more alternative interpretations that will define the methodology behind these new models. And all this work will require much more internal cooperation between risk and finance, and everything will have to be accepted by the statutory auditor. Lastly, robust governance controls around and the auditability of all these new data, models, interactions, and calculations will be crucial. An important area that will be getting a special attention will be the Ifrs9 models and management of the model risk thereof. According to some senior model risk managers, Ifrs9 will have a significant impact on banks' MRM processes. Therefore, role of model risk management should not be underestimated in any Ifrs9 implementation. When we talk to banks around the world about their Ifrs9 programs and the challenges that they face, what we hear often from them is that the area of methodology simulation, assessment, deployment is the most concerning for them. Let's have a look together how SAS can help your financial institution to deal with these challenges in the most optimal way. SAS has put together an impressive proposition with modules covering the whole end-to-end Ifrs9 impairment process. Starting from the data management, covering all aspects of data collection, preparation, and quality checks and governance, then going through modeling of all relevant ECL factors that are needed for Ifrs9 impairments, and continuing through the ECL calculation, methodology simulation, and assessment environment, and finishing with the production environment, making of the accounting entries and orchestration of the whole end-to-end process. In this production environment, the monthly ECL calculation and reporting processes will be coordinated following defined workflows together with the involvement of all relevant stakeholders. The focus on governance, traceability, and auditability is the key here. And as mentioned earlier, important is to highlight the model risk management component, ensuring the robustness of all the models running behind the scene. Due to the limited time today, I will focus on the heart of our solution, which is the model execution, simulation, and exploration environment, which allows our customers to assess the various competing Ifrs9 impairment methodologies on their financial impact, workload, and their conservatism and robustness, and analyze their sensitivity to changes in the underlying parameters, rules, or scenarios. In the end, we enable them to identify the methodology that offers the most optimal balance between these indicators. And how can we do that? By leveraging the SAS model implementation platform, the Ifrs9 analyst can group various models, no matter where they come from, into model groups and assign these model groups to particular portfolios or sub-portfolios and link them with various scenarios. All done in an intuitive, business user-friendly environment, where all these components are grouped and in the end translated into high-performance code, which will derive results close to real-time for the analyst to assess the impact of a particular methodology using interactive drag-and-drop interface. Due to the flexibility of the environment, the business users can easily assign different models to different portfolios and different scenarios in order to see what the impact would be in real time. At the end of the process, SAS generates a high-performance code which can be immediately deployed into production. And in the case that we change the underlying methodology or models or scenarios, we can again, by click of a button, assess the impact and generate the new code and redeploy it into production. Lastly, but not least, this environment can be used in the same way for performing other analytical tasks, like stress testing, where certain components can be shared and synergies achieved. But let's have a look together how this could look in the real life. We are looking now at the model implementation platform module of our Ifrs9 solution. This is an online environment where business users can choose different portfolio data, link it with the respective economic data, in other words, scenario definitions, and most importantly, assign different model groups to different products or sub-portfolios. In this case, we are using 2 consumer loan portfolios, one for purchase of new cars and one for purchase of used cars. Important here is that if I want to apply different IFRS 9 methodology, I just simply select the respective model group mapping. In other words, different models assigned to different portfolios. And if I am happy with my selection, I can run the calculation. But I have already done it earlier today. So what is it that we will get once such run is completed? First, I get generated a high-performance code which links all the data, models, and scenarios and is ready for deployment into production. But before doing that, of course, we need to explore the results of this ECL calculation run first. This is the user-intuitive results exploration interface, where business users can choose the variables, portfolios, and scenarios they want to analyze. So let's say I, as IFRS 9 analyst, want to assess impact of my selected methodology on the volatility of my provisions in the future and across different scenarios and aggregations. First, I will select my scenario that I want to use to assess the impact of my methodology. Let's start with the baseline scenario. Then I select my ECL results that I want to analyze. Please note that we calculate immediately both the 12 months and lifetime ECL. Later on, according to the staging rules that were defined in our Business Rule Manager interface, the right ECL will be assigned to each instrument. Lastly, I want to analyze the ECL developments across different aggregations. In this case, I choose region and add it to my analysis. So what is it that we see now? We see the evolution of both loan balances and ECLs across future balance sheet dates under my baseline scenario and different aggregations. In this case, I can drill down the results by region and even down to individual exposure level. All the aggregation numbers are recalculated on the fly. Now, let's assume I want to first analyze my ECL distribution across different regions and see if there is anything out of ordinary there. By click of a button, I can see the visual distributions of ECL across regions. I would like also to see distributions of the outstanding loan balances in order to identify any potential concentration of ECL. I immediately can see that Arizona region is the 3rd biggest ECL region, but by outstanding amount, it is much less important, which suggests high ECL concentration per €1 of exposure in this region. Now, what I would like to understand is how the ECL of this region is evolving across different time horizons. Here we see that ECL of this region is during the coming years increasing quite significantly. We should keep in mind that we are looking now at just one scenario, the baseline scenario. Let's explore how this picture looks under different scenarios. So now I simply add the additional scenarios, and I want to see if there is maybe something specific about my baseline scenario that is causing this development. Now, what immediately catches my attention is that the PD shock scenario is having by far the biggest impact on this region. And of course, I would like to understand whether it is just this region or is it the whole portfolio behaving like this. Therefore, I do the same thing for my whole portfolio. Now, this is something interesting. Actually, for the whole portfolio, it is the RTG shock scenario having the biggest impact. This suggests different sensitivity of my regions to scenario risk factors. In this case, I should probably consider applying different set of models to different regions for my ECL calculations. Let's explore now the sensitivity of ECL in my region to a particular scenario risk factor. For this, I will create a new scenario on the fly, which I will base on my existing baseline scenario. By doing this, I will take all baseline values of the scenario parameters as starting values, and I will adjust just one risk factor. In this case, I choose the unemployment rate, which is set to 6% in the baseline. Let's change this value to something like 150 increase. Let's see what the impact of this scenario on my portfolio and regions will be. I save this scenario and deploy immediately into my calculations. And then I just drag it to my analysis. Everything is calculated on the fly, and I can clearly see that the impact of this scenario on my Arizona portfolio in January 2017 is quite high. Being able to perform analysis and simulations just like this, using multiple scenarios, is becoming crucial for the Ifrs9 Impairments implementation programs. According to guidelines published recently, considering just one future scenario in your ECL calculations is not going to be good enough anymore. You have just seen how SaaS Model Implementation Platform can help you with Ifrs9 Impairments implementation program. To conclude, the SaaS Model Implementation Platform is a powerful, intuitive solution that enables the business user to perform fast and efficient methodology impact assessments, and in the end, deploy complex systems of credit risk models in a controlled and flexible manner. But this is not where it should end. As mentioned already, Model Implementation Platform and the other components of our Ifrs9 proposition can be as easily used also in other calculation-intensive areas, like stress testing. Using one central environment for both Ifrs9 and stress testing processes allows our customers to share a number of components and in the end achieve synergies and increase efficiencies, not only on the technology side, but also both on the people and process side. For more information, please visit our Ifrs9 solution webpage or approach me directly. I would like to thank you for your time and have a great day.
Okay, I believe you guys have seen much of what we've said and much of what we're going to say. Now, the reality is that doing this requires a lot of resources, data, human, skills, technology, and etc. But again, they've told you that Rome is not built in a day. There's a room to start from somewhere, and you gravitate towards a more sophisticated and complex, what's it called, model as time goes on. And that's the reality of it. Now, let's now start from the basic. The first thing is this: Ifrs9 impairment model only applies to financial instruments. And to be specific, it only applies to financial assets. Okay, it doesn't apply to any other assets, especially fiscal assets in which other standards may have addressed, or IS 36 may have addressed specifically. Likewise, there are some financial assets that it may not apply to. Okay, and we're going to see that as a move on, such as financial assets that are measured at fair value to profit or loss. Okay, and such as some other financial assets that may not be required to be carried out, or because it has other features embedded in it. Okay, but to higher extent or to greater degree, is applicable to all financial assets. Now, specifically, Ifrs9 applies as follows. It applies to every financial asset measured at amortized cost. It applies to financial assets that are mandatorily classified as fair value to OCI, including equity. Okay, but before you recognize payment loss on equity in such a class, it must be of a permanent nature. It applies to loan commitments, where there's a present obligation to extend such a credit, except where they are measured at fair value to profit or loss. And it applies to financial guarantee contracts, except those measured to profit or loss. It applies to lease receivable that is within the scope of IFRS 16 now. Okay. Okay. And it's also applicable to receivables that arose from contract with customer in line with IFRS 15. Okay. Any question? Okay. Let me now take you through our notes to explain some things to us. Impairment of financial assets. Now, Ifrs9 provides the following guidance. 1, adopted the ECL model. And what is that? The expected credit loss model. 2, the ECL model is a forward-looking model. 3, the ECL model has 2 approaches, which are the general approach, which recognizes 3-stage modeling, and the simplified approach, which is much more embraced by a provision matrix. Okay, that impairments assessments and tests on financial assets should at least be carried out once in a year. Or more on a continuous basis within an accounting period. Now, this summarizes how our journey will start. Okay. Now, let me start with number 3. Approaches. To ECL model. The first approach is the general approach. And it is a 3-stage model approach. While the second is a simplified approach, which is adopted when it is practically expedient to do so, thereby adopting the provision matrix. Now we'll start with the general approach. I said the general approach is a 3-stage model. And the beauty of the general approach is that the general approach calculates 12-month expected credit loss and also can calculate a lifetime or full lifetime expected credit loss. And what do we mean by 12 months expected credit loss and full lifetime? To do that, we need to first of all answer the underlying questions. What are the underlying questions? A general approach, would produce 12 months expected credit loss and can also produce lifetime ECL. What is the difference? Is our ability to answer these questions. One, what is a credit loss? Two, what constitutes expected credit loss? From there, we can now talk about relationship between 12 months and lifetime, 12 months and lifetime ECL. Okay, we'll go back to our presentation slide. Now, what is credit loss? Credit loss is simply the shortfall in cash flows. What do you mean by shortfall in cash flows? I will explain it here. Now, what is shortfall in cash flow? Let's assume this scenario. Let's assume this scenario. You have loan payments due from Mr. A to you as thus. Year one, 1 million. Year two, 1 million. Okay? But the current condition is such that the current condition is such that you estimated that you can only collect the following. Year 1, 900,000. And year 2, not more than 750,000. Therefore, your credit loss or losses is as thus. Yeah. Contract 1 million, which means over a 2-year period, you expect to receive 2 million. But collectible cash flows, what you emphasize you can only collect, or recoverable cash flow, is 900 and 750. That is 1,650,000, which means your shortfalls are 100,000 to 50,000. All in all, 350,000. This is what we mean by credit loss. Now, how do you get this? It's what we mean by forward-looking. How do you get this information? It's because you are projected into the future based on the information you have, based on information you have about Mr. A, and not only about Mr. A, about the economies to which Mr. A operates in, about the industry in which Mr. A operates in, and all sorts of things that we call microeconomic variables about Mr. A. Because, take note, if something is wrong with Nigeria, and because you currently work in Chevron and you are collecting with salary, does not mean something is not wrong with you. It's a matter of time. Which that means that it's not just your ability to collect your salary, but if it comes to a level where Chevron can no longer generate revenue because of security issues, it will affect revenue of Chevron and up to the level that it affects you also. Which means it is not just about your own uniqueness, it's about everything around you, which are what we call macro. Which means you use the micro, you use the macro as forward-looking variables to achieving your objective or gathering your data. That is that. Any question on what is credit loss?
Yes, sir.
Yes.
Yeah. So we have established that the difference between our contractual cash flows and our collectible cash flows.
That is cash flow estimated to be collected based on the condition that you have estimated.
Yeah. That's what leads to our cash flow. But what are the events that would lead to us having shortfalls in reality?
Yeah, okay, we'll come to that level. Okay, what we call loss events, what we call indicators, or what we call impairment triggers. All of those things we'll consider it as we move on. But the first thing is that now we want to even ask ourselves, do we understand what credit loss is about? Okay, we now know what credit loss is about. It's just cash flow shortfalls over the lifetime of the financial assets. The next question is, what then is expected credit loss? Now, what is expected credit loss? Now, expected credit loss take into variable scenario analysis. What do I mean by that? Okay. What it means is that it considers all possible outcomes. Okay. We are not in a stationary environment. We are not in a static condition. We are always operating in a dynamic nature, probably because the Earth revolves its own axis and also revolves around the world or the other planets or the sun. Probably that accounts for the reason why we are dynamic in nature, why there are different paths to which one can pass through to get to the destination. And what does that signify is that we assume from what we have done that 900,000 is what I can get, 750 is what I can get, which are point estimates. But statistically, point estimates are not reality, because nobody can give things about the future with exact science or perception. Therefore, what do? We try to model different scenarios, different state of the world, different state of nature, to say, what if it is this, what do we get? What if it is that, what do we get? And on the basis of that, we now find the average, which is more or less like it should fall in between this continuum. And that is what expectation comes into play. You know, most of us as accountants, we know that at some point in time, we do the word expected value. And in accounting or in finance, expected value is represented by this equation. And which means expected value is the probability of that value multiplied by the cash flow, in this case, of that value. Which then means that if you now look at it, you now look at different state of the world. Probably you have state of the world from 1 to n. Probably you have 2 scenarios, which means 1 to n is 1 to 2. Probably you have 3 scenarios, that is 1 to 3, and etc. By the time you do this, you carry out what we call the weighted average of credit losses with the respective risk of default occurring at different weights, and I will explain. Now, let us come to this slide, our work note. Let me share our work note. Scenario I pointed here is stationary. It's more like a point estimate. But let me copy my definition of expected value. I'm trying to use scenario to explain it. Now, what is expected value in this case? Now, let me assume similar scenario of Mr. A above. But we observed that there are 3 states of nature in which possible defaults default can arise. Now, let me say this is the state of the world. State of the world. Okay. Optimistic. Optimistic states. Most likely states. And pessimistic states. And let me call this the weight or the probability, as the case may be, which will sum up to 1. Remember the theory of probability? Sum up to 1. Okay. Let me say, and this is the credit loss at each state. Year 1, year 2. Okay. Let me change this drawing. The weight for optimistic is 35%. The weight for most likely is 40%. The weight for pessimistic is 25%. I think when we sum it up, it should be 100. Okay. Next is we have the estimated cash flows. And we have the years. Year 1, year 2, year 1, year 2, year 1, year 2. This was 900,000. We said 750. This was 800. We said 600. This is 600. We say 450. Now, these are various scenarios. Scenarios that if you are optimistic, 35% of the time, this is what you are likely to get. On the average, this is what you get in year 1, this is what you get in year 2, 40% of the time. And pessimistic is that this is like a worst case scenario, where in year 1, you can barely get 600,000 and barely get 450,000 at the end of year 2, which is about 25% of the time. And therefore, the question then is, what is the expected credit towards loss? And to do that, what we do is this. Okay, I'll do it on Excel and I'll come back and copy it. Okay. Okay, let's have it year by year. Year 1. We have optimistic, most likely, and pessimistic. Okay, what is the contractual cash flow? Now we estimated to collect 900, 800, and 600 in year one. What's our credit loss? Our credit loss is the difference between this and this, and that is in a different state of nature. The question then is, what is the weight? The weight, according to this, is optimistic is 35% of the time, most likely is 40% of the time, and 25% of the time. At every point in time, your aggregate state of nature, their weight must sum to 100%, or your probability must sum up to 1. Now, what do you do? The product, the expected credit loss, in this case, will now be the products or you multiply straight this to this. And what do you get? And when you sum it up, 100, what you get on average, what you have is 215. Now, this is the credit loss for year one. We'll repeat the same thing for year two. Year two, we have 750. We have 600. And we have 450. Remember, we also get this. Okay. And that is what we mean by expected credit loss, building in weights or probability into that. Okay. At this point in time, we probably ignore the effect of time value of money, but we are coming to that later. Any question? Any question? I'm expecting your comments, guys.
Yeah, good afternoon.
Good afternoon.
Okay, based on the presentation on the whiteboard, I think, and on the Excel sheets, I think it is fairly presented and you are taking it step by step. I don't really have any question because I'm following the process you are taking.
Okay, thank you. Now we try to answer a question. we said what is credit loss and what constitutes expected credit loss. We've gotten that. Okay, and I'll now extend it further. You know, I first of all told you that credit loss in this perspective, we assume no discounting and all sorts of things. But in its real sense, in-depth of expected credit loss ECL is a function of the following. Practically, there are 4 factors that influences the ECL. The first factor is the PD. Second factor is the LGD. Third factor is the EAD. And last factor is TVM. The question then is, what are these? They are things you are familiar with. When we say PD.
Hello, sir, please switch back to the board.
Okay.
Back to the note here.
Sorry. You have to remind me at every point in time if I fail to switch. Okay. I said ECL is a function of PD, LGD, EAD, and TVM. And what are they? PD is a probability of default. That is, what is the possibility of occurrence of Mr. A defaulting? Because he may not default, but there's also a chance that he may default. If it's certain that he will not default, the probability will be 0. If it's 100% certain that it will default, the probability will be 1. But the degree of uncertainty ranges between 0 and 1. And therefore, our probability of default is the possible outcome over the total outcome. What does that mean? Remember, probability of a coin, tossing it once, and you get a head. What's probability that you get a head? What's probability that you get a tail, and all sorts of things. And you move on to level of conditional probability, which is what is much more relevant here, through the Bayes theorem and some other things like that. But in simple terms, this is the probability of default. Okay, the probability of default can be derived either in count or in value. What do we mean by in count? In count is to say, if you have 10 people you have borrowed money to, or you have lent money to, what is probability that they will default? It might be 2 out of the 10 people. That is 2 over 10. And that is 0.2. But that might not be valid because the likelihood of the 2 might be more in value than the other 8 that did not default. What does that mean? You gave one person 1 million and every other person 100,000. Which means if you use count, it might not be valid because the 1 million might fall as a default. Therefore, that 1 million alone is far more than the others. Therefore, you can use value. But most of the time in today's world, because of the distribution of cash flows, we use value rather than using count. But again, depend on what is unique, and it depends on your internal models. Okay. Next is LGD. LGD is otherwise known as loss given what? Default. What does that mean? Loss given default is determined inversely or from an indirect perspective from what is considered the recovery rate. Which is RR. That is RR. What is recovery rate? Now, your historical data has shown to you that when somebody defaults, what does that mean? That means somebody is now struggling to pay you as at when due. But even when somebody defaults, doesn't mean you lose all of the money. No. Default only signifies the economic constraints that has prevented the person to have enough cash flow to pay you as at when due. The question then is it possible for you to realize anything by any means from that person? Does the person have collateral? Is there a way you can use legal means and other means to ensure you get the money? And experience has shown that certain level of debt, when they default, and you table them, some of them you are able to get as much as 40% of the default amount back, some 30%, some 10%, some 80%. On the average, what is your recovery rate? Which means what were you able to salvage? It's like when somebody owes you and cannot pay. The question is, it's not necessarily that you lose all what he cannot pay. By the time you owe that person, you go to his house, you seize the car, or you more or less use legal means, and he committed to pay something, what you're able to retrieve back after default from the old outstanding will tell you your recovery rate. And inversely, what you cannot recover becomes your loss at the point of default, which is the LGD. And that's what it means. Okay, even though there are different models for this. We may go with different models as time moves on. The next one is EAD. EAD is your exposure at default. And your exposure at default, depending on the bucket to which your financial asset lies, can either be your gross carrying amount of financial assets at default, or it can be your net carrying amount of financial assets at default. Can you recall? Okay, don't let me waste time now. I'll explain what the gross carrying amount means. Gross carrying amount means the carrying amount of a financial asset before impairment is deducted. Prior year impairment is deducted. While the net carrying amount is the carrying amount of a financial asset after deducting prior year impairment allowances. That is that. What it simply means is that the balance that the borrower is owing you as at the time it defaulted is what we call exposure at default. At this level, the exposure at default, we just more or less assume that there is no further commitment to assess credit even when you are default. That's a more complicated issue. But at this point in time, we just assume for simplicity's sake that once you default, even when there are commitments, you can't access such funds again. Okay, which means your exposure at default at this point will only assume to be the money owed as at the time of default. Okay, that is that. And lastly, TVM. Who can guess what TVM is? If you follow this trajectory, what should be the TVM? What should be the TVM? I can't hear you.
Time value of money.
Thank you. Time value of money. Now, time value of money is to incorporate discounting principle or technique. In summary, what it means is that our ECL is the sum from year 1 to year end. The PD, that means the product, or PD multiplied by LGD multiplied by EAD, which will be discounted by our effective interest rate over the end period. And that is what it means, which means invariably what you are doing is PD in year 1 multiplied by LGD in year 1 multiplied by EAD in year 1 discounted by effective interest rate in year 1. You do that also for year 2. Discounted back 2 years from now, up to year end. Anything you get here, let's say is 243,000 naira is our allowance for credit losses. Does that make sense, please? Does that make sense? Is it becoming more interesting?
I have to take that.
It's becoming more technical.
Technical stuff. These are basics. But again, you know, some of you are not mathematically inclined. When you see things like this, your eyes start to crumble, especially if you have not eaten. But there's nothing like that. What we'll do is, I'll now use, to this level, I've explained what it is. I'll now use this to guide you. Let's look at this exercise in your practice question about Asewenga and Joseph Mourinho. Can somebody read this question?
Question 8. Asawinga purchased 5% bonds.
Okay, continue, yeah. Can you see it? Continue.
Yes. Question 8. Asawinga purchased 5% bond in Jose Mourinho's on 1st April 2017 in the primary markets for 1 million naira. The indenture, the term of the bonds issued, was 5 years maturity with a value of 1,305,350 naira. The effective rate of interest on the debentures is 10%, and the Ifrs9 conditions are satisfied for the investments to be carried at amortized cost. As of 31st March 2019, Jose Mourinho had filed for bankruptcy and immediately went into liquidation. All interest had been paid until that date. On 31st March 2019, the liquidator of Jose Mourinho had announced a reduction of remaining interest by 40% and that only 80% of the terminal maturity value of the bond will be paid upon realization of the assets of Jose Mourinho, which is expected to coincide with the original repayment cash flow dates. The market interest of a similar bond is 8% on that date. Required. A. What will have been the carrying amount of the bond just prior to when it is evident that impairment of these investments are set in? B. Considering the possible impairments of the investments, what would have been the amount to be recognized post-impairment assessments? C. If any, how will the impairment loss be reported in Asawinga financial statement for the year ended 31st March 2019?
Thank you very much. Now, the first thing is that we are told to determine the kind of amount even before impairment, Abi? And who can tell me, as at what point do you have evidence that Mourinho has defaulted? At what point has Mourinho defaulted? At what point has Mourinho defaulted?
Well, he filed for
31st of March 2019.
Okay. He defaulted at that point, have you?
Yes.
Okay, thank you very much. Therefore, which means year 1 and year 2, there was no problem because he was paying as at when due, have you? Now let's extract our information. Let me copy this input data. Okay, let me just try and copy this. Okay. Now, I just want to use this template. Now, we are the one that gave loan to Wenger, or we invested bond value. Is it a bond? Yeah, bond face value. How much was it? 1 million, okay. How many years was the bond? If you count it, it's a 5-year, okay? 5 years. Was there transaction costs? There was no transaction cost, but at maturity, it will be redeemed at premium of 1305350. I'll come here, somewhere here. Let me try and create. Let me just put a line here. I'll now draw this down. Redemption value, which is at premium, because we are redeeming above 1 million. I think that amount is correct. Now, they gave us effective interest rates. Effective interest rate is 10%, while the coupon rate is 5%. There's no transaction cost. Effective interest rate is, contractual rate is 5%. Effective is 10%, but we'll derive it ourselves. Okay, we'll derive it ourselves. Okay, now upon initial recognition, it's not a liability, but a financial asset. And we are told to measure it at amortized cost. Okay, therefore, at the point of investment, we debit financial assets and we credit bank. Therefore, I change this to financial assets, 5% bond. Okay, and transaction cost, if any, will have been used to reduce added that it will be used to increase our investment in the bond. Okay, that is that. Now, what else do we need to do? We need to determine our effective interest rates. Now, but before then, we determine our contractual cash flows. Now, what is the net bond investment? It's not loan now. Net bond investment. What we invested in bond is the face value plus the transaction cost. But in this case, transaction cost is 0. What are the interests do we expect to receive from the bond? The interest we receive from the bond is a product of the coupon, which is 5%, and the bond value, which is 1 million. I'll log that, and which means 50,000 is what I expect to get. And I'll get that for how many years? 4 years. Before principal, remember I invested this amount, therefore it will be negative at start. And as I receive 50 million, it becomes positive. At the end of the day, I'll collect 50 plus the redemption value. What is the redemption value? This amount. Now, this is my cash flow pattern for the okay, it's 5 years now. Therefore, I have to increase this 5 years. This will be year 5. Therefore, This will be year 4. Okay, I sum it up. Yeah. Okay. Now the question is, what is my effective interest rate? My effective interest rate is what gives this to be 0, which I can also do it by this rate. Now, if I use rate as a function, what do I need? Number of term is 5 years. Payment of cash flows. I get how much each year. I get the product of 5% of the face value. That's 50,000. My net investment is this cash flow. My future value is this amount that I will get, and it's 0. Okay, why is this giving me error? Check. What have I done wrong? Okay. My outflow. Okay, this is already negative. I don't need to put negative again. So if I'm picking it from here, or if I pick it from here, I might put negative in front. Therefore, what does it give me? It gave me 10%. That is how they got that 10% they gave us in the question. And I can also use IRR. What is IRR? IRR is giving me that 10% straightforward. You can see it here because it's a model. This is my entire cash flow here for this period. And it gave me that 10%. It gave me the same answer. I can also use go seek. If I use go seek, remember the discount factor has been linked. This B18 has been linked here as my discount rate. Okay. If I use that, it gives me something different, but it's negative. But what we need to do is to seek this goal so that this negative 293,598.58 in thousands becomes 0. And to make it 0, I go to my data, I go to my what if analysis, I go to my goal, and you can see that it's identifying the goal I want to seek, but what value do I want to be there is 0. And what variable will influence it to be 0, which is the changing cell, is this rate. Therefore, what rate will give me 0? Can you see it gave me the same result? If I expand it, you see that it will give me the same thing, which means at every point in time, it gives you the same thing. I just try to prove to you how they got 10% from the question. Okay, now given that, that is what we now use so that it has influence on what you have done here. Let me just copy this. Okay, now let us start. How much was my investment? 10 million. My effective interest rate is what I have here. Which I locked. And I can use it to drag down. What is my cash flow? My cash flow is 50. Therefore, I can put them in negative. And I drag them down. Remember, my period is 5 years. Let me bring this down by 1 year. So I can put my year 5 here. at year 5, it becomes a 0. What is the total interest? 555,350. What's the total cash flow? 155,350. What is the difference between them? Is 555,350, which is your contractual interest. And your contractual interest and finance costs remain the same. Why? Because the amortized cost portion, transaction cost is 0, which means there's nothing to amortize. For example, if I just change transaction cost to be 2%, it changed everything. And it means this is no longer effective interest rate. You can see that these two models did not change because I've not considered my transaction cost in this day. But this changed automatically. And if I link this answer to this, you'll find out that everything will become 0 here. Where's it? Now let's go back there. What is my transaction cost? Let's go back to the model so that I can model transaction cost along with it. Even though in this question we have no transaction cost. Therefore, my PV will now be this plus the transaction cost on the investment, which is this multiplied by what you have here. Therefore, you can see that the two now agrees. Okay, which means if I've also modeled here my transaction cost, this to become 0, what do I need to do? Is to seek the goal again and say, what is my goal? Ensure that that is 0. And what do I need to change? My effective interest rate. And which one gives me this value? This gives me the value. Now, at this value, you can see the 20,000 coming up. You can see the 20,000 coming up, which shows the transaction cost of 2%. Now, what is wrong with this is that in our rate, we deducted transaction cost instead of adding it. Or what do we do here? Yes, I think we added transaction cost. Now, in this question, there's no transaction cost. We just leave it at what? 0. Okay, I'll go back to my GoSeek or copy these formulas and paste it here. And that's giving me my results. Now, what we needed, we don't need the full year. I just use that to show us the knowledge. What we needed is this period. What we needed is the first 2 years. Why these periods, I'll gray it out. These are not needed. I'll just put it in white background so that you don't see it. Okay, but they are there, but you won't see it because I put it in white background. And let me take off the view panels there, the grid lines. And the borders. Okay, this is what I want you to see, but when you get the Excel, you can see all. And that's part of the secret of modeling. You thought nothing is there, but something is hidden. Okay, especially if I don't want you to interfere with it. Now, that is that at that point. Okay, now the first question says, what will have been the kind amount of the bonds just prior to when it is evident that impairment of the investment are certain? What will be the answer? The answer is this amount here, 105. That's the answer, 105. Let me put it in a color visible for us. Okay, that's my answer. The answer is how much? 105, 30.43. That's the amortized cost, which is also called the gross carrying amount. Okay, that's the answer I have. Okay. Now, what's the second question? Considering the possible impairment of investment, what would have been the amount to be recognized post-impairment assessments? Now, that is where we are coming to. Now, let me correct this entry because we are not talking of loan here. We are talking of asset, not liability. Therefore, investment income or interest income, and that will change the narrative. It includes financial assets. If I can copy this, and you have finance income, which is an interest income. Credit profit or loss for each of the years, and these are our cash flows. We see 50,000. Those are the entries we will have passed. That answer year one, that's question one. Question two is that considering the possible impairment of investment, what will have been the amount to be recognized post-impairment? That is where our model needs to set in. Therefore, to answer B now, I need to first of all determine the credit loss. What is a credit loss or losses? Therefore, what is my, I'll pick it year by year. Year one, okay, sorry. I'll distort it because there's something hidden here. It's not onto me. Okay. Okay, don't worry. Now I'll put it here. Credit losses. I now need to estimate year three, which might be my period one estimation. I'll do for year two, year four, and year five. Those are the years left out. Year four, which will be period two. Okay, what is my periods? This will be period one from today, period two, period three. Let me write it in details. Period from now, and now is as at the reporting date, 31st of, what's our reporting date? 31st of March, have you? 2019. Because this year run from April to March. Okay. Now, having this position, what then do? We determine what is our contractual cash flow. Contractual cash flows according to our estimate, then we are expected to receive this in year 3. We are expected to receive this in year 4. And we are expected to receive this in year 5. Now, what is our estimated cash flow recoverable at the point of default? Look at the question. What does the question say? It says, as at 31st of March 2019, Jose Mourinho had filed for bankruptcy and immediately went into liquidation. All interest has been paid up to date. That is the first 2-year interest. On 31st March 2019, the liquidator of Jose Mourinho had announced a reduction of remaining interest by 40%. What does that mean? It means they are telling you that based on what is on ground, creditors, what we are seeing on ground, the assets on ground, by the time we sell and everything is done appropriately, we don't think you can get more than 40% of your interest. Now, not only that, you can only get it as at when due. When due means that as at when they are primarily due to be paid, which means it's not that you are getting it now. Which means you are not only going to suffer reduction in what you get, you also suffer time value of money, because it is not only today, interest will be paid to you as at when due for the next 3 years and at a rate of 40%, which means invariably from the rate of interest, you are only going to get what? 40% of this amount. Let me just link it up, 40% of this amount. You know, there's interest in year 3. Let me just put that one separately because we are not showing it separately. Or what I can do is to show it separately. Just wait, I'm coming. Let me say this year 5. Period 3. Therefore, I'll separate this into interest and principal. Okay, it is here, interest and principal. In year 5, you get 2 payments. Therefore, this is also this. Now, what happens to the principal or redemption value? And that only 80% of the terminal or maturity value of the bond will be paid upon realization of the asset of Jose Mourinho, which is expected to coincide with the original repayment dates, which means this redemption value of 1305,350, you can only recover what? 80%. 80% of that. Which means invariably, what is our shortfall? Cash flow shortfalls. Is a difference between what was contractually agreed and what the current condition can allow you to get. These are the cash flow shortfalls. That is that. Now, alternative to that is you can also get the cash flow shortfall by saying, alternative to that, you can get the cash flow shortfall as follows. What is your recovery rates. In percentage. Interest. You can only get it recovery rates, interest. You can only get 40% back in each year, and the redemption value can only get what? 80% back. Therefore, what is your cash flow shortfall? Your cash flow shortfalls, in this case, are the products of this. Your recovery rate is 1 minus, sorry, your loss given default is 1 minus your recovery rate. That is 1 minus 40% is 60%. That's what you can lose of how much? 50. And that gives me this value. And this is what I do, which is the same figure you get. Which means this approach says you need your loss given default, which I can also claim here to say my loss given default in percentages is equal to 1 minus recovery rate. Okay, let me change that color to something like this. And that is just 1 minus this. Make sense when they come back. Okay, that's 60. And this is 20. Therefore, I can change my formula. Instead of writing this formula inside, I can just apply it on these rates and still give me the same answer. Just to make it step by step. Now, this is my credit loss, but I need my time value of money. There's no state of nature here, therefore I have no probability. Therefore, what do? I come here and remember this shortfall in cash flow is my credit loss, which in this case, I will apply it as my okay. Now, this contractual cash flow here is synonymous to what you know as your EAD. What is EAD? Exposure. At default. Okay. The same thing have here. Now I need my present value. And for me to have present value, I need my discount rate at effective interest rate. Don't ever use market rate. Use the original effective interest rate. Information here is just to deceive you by giving you market interest rate of similar bond so that you don't go and use it. It's not relevant. What is relevant for impairment purpose is the original effective interest rate of the financial instrument. Therefore, what is the original effective interest rate here? Go back, we have it here, which is the 10%. Now, we'll use that as our basis to discount. Remember, discount rate is 1 plus R, and that is our R. In this case, I'll lock it. raised to power n minus 1. Okay. I'll put that to decimal places, as many decimal as possible. Let me just maintain 4, which has always been the best practice. And I do that. Okay. I only try to split this for convenience sake. Yeah, which means this will have the same rate because they are both 3 years. Therefore, what is my present value? My present value is what I have here. And what is it? Is the product of my discount factor at the end of the day. When I aggregate this together, my expected credit loss is the sum of the PV of credit losses over the period. And in that case, what is it? The sum what's the sum? That's 270. That is what they expect us to do. Okay, these are credit losses. And to determine expected credit loss, what do we do? Is for us to discount it all and sum it all our shortfalls in cash flows. Which means in this case, the question is, considering the payment of this, what will have been the amount? What will have been the amount will be the difference between the net carrying amount as at 31st March 2019 will be the gross carrying amount as if impairment has not arisen, which is this 1.5 million we had, less allowance for credit losses based on Ifrs9 ECL model. And what's Ifrs9 ECL model? Therefore, what's our net amounts? These are net amounts, which you will have reported as your recoverable amounts in the balance sheet. And that is the B. Does that make sense? Okay, that is that. Now, the last information is, if any, how will the impairment loss be reported in Wenger financial statements? See, impairment loss of 270,741.89 will be recognized as an allowance for credit losses against the amount of the financial assets, that is the bond investment, and be used to reduce the carrying amount of the bond to what is recoverable as at the reporting date, which is 31st March 2019. The movements in the allowance for credit loss would be recognized as an impairment loss or impairment gain if it reverses itself in the profit or loss for the year ended 31st March 2019. In this case, in this particular case, there were no information. There was no information on allowance for credit losses in the prior year. Hence, we assume zero allowance made. And the difference, which is 270,741.89, will be accounted for as an impairment loss for the year ended at 1st March 2019, being an increase in the allowance for credit loss. In the books of Ashwin as a wonder. Therefore, okay, that should give me my reports. Any question? Any question? Any question?
Okay, I just have an observation. I don't have question per se.
Okay.
And the observation is where the clause said the bond would be reduced by 40. I can't really recall how they phrase it, but they say it will be reduced by 40%. I think the recovery rate should be 60%, while the expected loss should be 40%. That was my own interpretation.
That means you didn't read the question well. Can you read the question again from this point? As of 31st March 2016, can you read it clearly and interpret it clearly?
Okay, as of 31st March 2019, Jose Mourinho had filed for bankruptcy and immediately went into liquidation. All interest had been paid. So that date, on 31st March 2019, the liquidator of Jose Mourinho had announced a reduction of remaining interest by 40%.
Okay. Okay, continue.
And that only 80% of the terminal maturity value of the bond will be paid upon realization of the assets of Jose Mourinho.
Okay, thank you. I think I got what you are saying. Okay, it's because I've twisted the question I sent to you guys. Okay, before now, one of the exercises I've given before now was to use the word reduced. Mourinho had announced a reduction of remaining interest to 40%. 2 means what you can get is 40. But in this by means what you will not get is 40. Therefore, if that is the case, luckily his exam model will change it. Recovery rate, they gave us default rate. Do you guys see now? They gave us default rate, loss given default is 40%. And take note, conversely also, you can always get recovery rate as 1 minus loss given default, depending on which one you have. Because the 2 will sum up to 1. Okay, which means in this question, they give us 40% is what is reduced by. And that is all true. And what that means that we now walk back to say 1 minus this. Does that answer your question now?
Yes.
Yes. Now let's go back. What did they say about 80%? Is it 80% that is lost or 80% is recoverable? Can you read that one? And that only 80%. Can you hear? Continue.
Okay, that's only 80% of the terminal maturity value of the bond will be paid upon realization of the asset.
That means 80% will be paid, which means we can recover 80%. In this case, they gave us 80% here, which means this 20% is correct, Abby? Okay, that is a twist, which means if we go by that, our loss now is 245. Is that correct? I can't hear you. Is that correct? Nudi, I'm expecting your answer. Is that correct?
Yes.
Therefore, I'll change it here. And that's the beauty of model. If it's what you type, you have to start all over again. And that's why if you are doing SEMA and all sorts of things, it's better for you to, you can easily correct your mistake. If it's paper, you have to start calculation and pressing calculator over again. And that's why when you also model, you must ensure you use input data sheets so that you just change it and everything links all together. Okay, that is that. I think that solves our problem now. Okay, I'll give you 10 minutes break again for us to continue. But during that break time, I'm giving you this question for you to practice before we now go into the theoretical aspect of impairment. Okay? Because what we just finished was to address this discussion we had here, which look as if it's a big formula. Now we have been able to use that illustration to address gross carrying amount and net carrying amount. And we have also used it to address all of these metrics here. Probability of default, loss given default, exposure of default, and to calculate our expected credit loss. Okay. I want you guys to practice this individually, collectively, you can discuss, but you have a break. We'll convert by 3:30. We have 20 minutes. Thank you very much, and God bless you.